Seven-figure traders are not smarter than you. They do not have better charts, better data, or a private source of information that never reaches a retail account. In many cases, they do not even have a better system for entering trades. The gap between them and the trader losing money at the same terminal is not what most people think it is. And the moment you understand what it actually is, everything about how you manage your account will change. The secret is not a better entry. The secret is a better relationship with what you are trying to build. Most traders treat their account as a vehicle for making money on individual trades. Seven-figure traders treat their account as a compounding machine, and they protect that machine with the same intensity most traders reserve for their best ideas. Because they have understood something that takes most traders years to accept, the machine itself, running at even a moderate rate of return without serious interruption, will reach seven figures. The trade is temporary. The machine is permanent. And every risk decision they make is made in service of keeping the machine running, not of maximizing any single trade's potential. The survivor wins the game. That is not a motivational phrase. That is the mathematical reality of compound growth, stated in its most essential form. And by the end of this video, you will understand exactly why and what the 5 components of the secret look like in practice. Let me show you what the failure to understand this costs in real terms. Not vague terms, real numbers. Kai had been trading for 3 years when he sat down to calculate his actual result. He was a capable trader. His analysis was solid. He had good entries more often than not. But his account had started at $30,000, and after 3 years of genuine work, 3 years of charts, research, discipline, and effort, his account sat at $30,677. $677 of net growth in 3 years on $30,000 of starting capital. He had made 15% in year 1, $34,500. He had lost 22% in year 2, $26,910, because in that year, after an early drawdown, he had traded larger and more frequently, trying to recover what the market had taken. He had earned back 14% in year 3, returning to $30,677. 3 years, $677. The compounding machine had not been running slowly. It had been destroyed in year 2 and rebuilt from near zero in year 3. Everything he earned in year 1, and then some, was erased by a single year of reactive risk management, and 3 years of real trading work returned him barely past where he started. Now here is the number that changed Kai's understanding of everything. If year 2 had produced a 0% return, no gain, no loss, capital fully preserved, his account at the end of year 3 would have been $39,330 instead of $30,677. The difference? $8,653. Not from a better entry, not from a better strategy, from 1 year of not losing, from protecting the compounding base during a period when his decision-making was compromised. And if year 2 had produced a modest 8% gain, achievable with disciplined portfolio heat management during a difficult market period, his account after year 3 would have been $42,476, a difference of nearly $12,000 from the same starting point, the same system, the same time frame. Only the year 2 outcome changed. This is the mathematics that seven-figure traders have internalized in their bones. Avoiding a 20% loss is not equivalent to breaking even. Avoiding a 20% loss is mathematically equivalent to achieving a 25% gain, because a 20% loss requires a 25% gain to fully recover. Avoiding a 30% loss is equivalent to achieving a 43% gain. Avoiding a 50% loss is equivalent to achieving a 100% gain. These are not approximations. They are arithmetic. And once a trader genuinely accepts this arithmetic, protection stops feeling passive. It starts feeling like the most aggressive return-generating behavior available. Protection is return. That is the secret, stated in 3 words. An amateur manages risk to limit how much they lose on a bad trade. A professional manages risk to preserve the compounding base that makes every future trade more valuable than the last. Here are the 5 components. Apply all 5 or the framework is incomplete. They are not independent tools. They are interlocking disciplines that protect the machine as a system, not as a collection of separate rules. Component 1 is the compounding preservation mindset. Before you open a chart, before you look at a single setup, ask yourself one question. Am I making this decision in the context of this trade, or in the context of the account I am trying to build over the next 5 years? These are not the same context. The 5-year context produces conservative sizing, high selectivity, and patience that feels uncomfortable in any single session. The single trade context produces urgency, oversizing, and the willingness to take setups that a 5-year trader would pass without hesitation. Write down what you want your account to be worth in 5 years. Write down what annual return rate would get you there. Then calculate. At that annual return rate, what is the maximum drawdown you can afford in any single year before the 5-year projection becomes mathematically unreachable? That number is your hard ceiling, not your target, your ceiling. Component 2 is portfolio heat management, the most underused professional risk tool in retail trading. Portfolio heat is the total percentage of your account that is at risk across all simultaneously open positions. Most traders think about risk one trade at a time. I am risking 1% on this trade, 1% on that trade. They open 5 positions at 1% each and never calculate that 5% of their total account is exposed to simultaneous adverse movement. A single correlated market event, a flash crash, an unexpected rate decision, a sector shock, can trigger all 5 stops simultaneously, producing a 5% single-session drawdown that no individual stop-loss was designed to allow. The professional rule: maximum portfolio heat of 3 to 5% total across all open positions at any moment. If 2 positions are open at 1.5% each, the next position can carry at most 1% of remaining heat. When the heat cap is reached, no new positions are opened until an existing one closes. This rule eliminates the most common form of catastrophic drawdown, the sequence of simultaneous stop-outs on correlated positions during a macro event. Component 3 is the asymmetric reward standard. This is where the patience pays. 7-figure traders do not trade every setup that offers a 1.5 to 1 reward-to-risk ratio. They wait, sometimes for days or weeks, for the setups that offer 3 to 1, 5 to 1, or better. Here is why this standard is non-negotiable for compound growth. A system with a 35% win rate and a 5 to 1 average reward-to-risk ratio is a profitable system. 35 out of every 100 trades win, 65 lose, and the system still grows the account because each winner returns 5 times what each loser costs. A system with a 55% win rate and a 1.5 to 1 reward to risk is marginally profitable and emotionally exhausting. The asymmetric standard produces fewer trades, each of which carries meaningfully more return potential per dollar risk. And because each trade risks only 1% of account, the waiting periods between qualified setups are not periods of lost income. They are periods of protected capital, which, as the mathematics above established, is itself a form of return. Component 4 is the drawdown response protocol. An amateur treats a drawdown as a problem to trade through. A professional treats a drawdown as a signal to read before touching the account again. Every professional trading operation, from a single-account retail trader to an institutional desk, has a written drawdown response document. Most retail traders have none. The protocol is not complicated. It has 3 trigger levels and 3 defined responses, written before the drawdown ever begins, executed without deliberation when the trigger is reached. At a 10% drawdown from the account's most recent high, position size is immediately reduced to 50% of standard. Trading continues, but smaller. The account is telling you something. Listen to it without panicking. At a 15% drawdown from the most recent high, Trading stops for 5 full trading days. No charts, no setups, no paper trading. A complete review of every trade taken during the drawdown period is conducted during those 5 days. The review asks 3 questions. Were the entries structurally qualified? Were the exits technically sound? Was position sizing consistent with the risk framework? Return at 50% standard size after the 5-day review with a written summary of what was found. At a 20% drawdown from the most recent high, a full trading halt of minimum 2 weeks is implemented. A written audit of the entire drawdown is prepared. The audit distinguishes between 3 possible causes: execution errors requiring behavioral correction, market condition mismatch requiring an environment filter, or system failure requiring structural review. Trading does not resume until the audit is complete and the cause is identified. Because trading into a 20% drawdown from a state of financial stress, emotional depletion, and compressed judgment is the fastest available route to a 30% drawdown. An amateur responds to a growing drawdown by trading more aggressively to recover. A professional responds by trading less until the account's story becomes readable. Component 5 is the equivalence mindset, the internal shift that makes all 4 components above feel sustainable rather than punishing. Most traders experience the 3-to-1 reward standard and the heat cap and the drawdown triggers as restrictions. They feel like cages around the potential of the account. That feeling is the signal that the reframe has not yet happened. Because when a trader genuinely accepts that preservation equals return, when they feel in their body that not losing 20% is the same as earning 25%, the restrictions become advantages. The session where they pass on 6 setups because none reach the asymmetric standard is not a wasted session. It is a session where they preserved 100% of their capital against 6 potential adverse outcomes. Each day the account is not damaged is a day the compounding base is protected. And the compounding base, protected consistently across years, is what produces the number that seems impossible from the outside. Trading is a long game, a game of consistency, a game of survival. Livermore understood this before modern finance had language for compound growth. He rebuilt his fortune multiple times from near ruin, not because he was the most aggressive trader of his era, but because he eventually learned to treat survival as the strategy. He wrote that the big money was made not in the individual trades, but in the sitting, in the patience to wait for the right moment, and the discipline to protect the account during all the wrong ones. The right moment and the protected account are not 2 separate things. The protected account is what makes the right moment profitable. Without the machine running and compounded, the right moment is one more trade in a series that never compounds. Alive traders can improve. Dead accounts cannot learn. Write that down. Every risk decision you make from this moment is a decision about whether the account remains alive and compounding or whether it joins the long list of accounts that produced correct analysis, made brilliant entries, and never reached 7 figures because the machine kept getting damaged before compound growth had the time to work. The 5 components are not rules. They are the architecture of a compounding machine. Build all 5, protect all 5, and give the machine the one thing it needs above every other input: enough time to run. If Kai's story is your story, if you have had a strong year followed by a year that reset the compounding base, type "the machine" in the comments. Tell me which component was missing. And subscribe now because the final video in this series builds the complete pre-trade checklist, the single-session protocol that integrates every system covered in this series into one decision framework you run before placing any trade in any market on any time frame. Protect the machine. The machine builds the life.